Okay, good evening. This is Professor Mayer, and this is, I guess it's our third chat session, and we're covering what I think are probably some of the two most important chapters in this book, where we are looking at the process where we are defining the audit. Last session, we covered a lot of technical material related to legal liability and some standards and so forth. But now what we're doing in these two chapters are really focusing on what it is that we do as an auditor. So as an auditor, we are examining evidence, we're examining documentation, and there's some very specific steps related to the overall audit process that's absolutely critical for us to understand. So I would assume, or I would say, that this session is probably one of the more important sessions in terms of understanding what it is that we're doing in relationship to the audit. And again, when we talk about the audit, we're focusing primarily on the audit of the financial statements. Corresponding to this is, we've talked about this in terms of completing what we call the comprehensive audit, where we're looking at both the financial statements and the audit of internal controls over financial reporting. So all of these two elements dovetail in terms of what it is that we're looking at and how we document and the complete process. So let's go ahead and jump into the material. We do have a lot of material that I want to cover, and one of the first things that we need to understand is that everything is relying on what we call audit risk. And let's just sort of talk about this from the perspective of what this really means to the auditor. Now, when we talk about risk, we talk about risk in general from the perspective of what could go wrong, the possibility of something going wrong. Doesn't mean that it actually has gone wrong, it just means that it could possibly go wrong. Audit risk is a unique form of risk, and it's the unique form of risk from the perspective of the auditor. So the auditor does not want to do things wrong. The auditor does not want to issue an unqualified opinion when in fact there are monetary material misstatements embedded in the financial statements. So that's the risk. The risk is that we issue an inappropriate opinion. So in simple terms, audit risk is the risk that the auditor is wrong. Well, the auditor doesn't want to be wrong. But the problem is that the auditor has to get the audit done in a reasonable time period. The auditor has to get this done and actually make money on the engagement. Auditing, by definition, is really a for-profit enterprise. We're not talking about governmental auditing or auditing from any other perspective other than the external auditor, and external auditors are in this business to make a profit. So we don't have unlimited time, we don't have unlimited resources, so what we're attempting to do in this process is to lower the risk from the perspective of the auditor so that the audit is completed in an appropriate time period, in an appropriate manner, so that we can get in and we can get out and everybody's happy. Okay, so how do we do the audit? We've talked a little bit about this, but we're auditing from the perspective of management assertions. So assertions are what management is bringing to the table. Keep in mind that the financial statements are the responsibility of management. Embedded in the financial statements are explicit or implied assertions, and these assertions are coming from management, and these assertions are related to account balances or the accounts. And when we talk about assertions on account balances, kind of think about the account balance for accounts receivable or the account balance for accounts payable. When we look at assertions related to transactions, we're looking at the process. So the transactions, as an example, revenue transactions. That revenue is an account balance, but we're also looking at it from the perspective of a transactional process. So we're looking at the controls related to revenue. We're looking at the controls related to expenses. Again, these are transactions. And then finally, we're looking at assertions related to presentation and disclosure. So we get back to this in the sense that assertions are explicit or implied statements by management that are embedded in the financial statements. So as an example, and we'll talk a little bit about this. I think this is a very interesting crossover. When we are looking at account balances, we're looking at two things in every case. We're looking at existence and completeness. Now, in transactions, same concepts, but we look at it a little bit differently, occurrence and completeness. So let's talk about those two issues, and frankly, this is really the process that we go through in the bulk of everything we do in relationship to the audit. So as an example, think about the assertions related to the, let's say, fixed assets. Okay, so management says we have $1 million of fixed assets. So what are they asserting? They're asserting that everything in the ledger related to fixed assets actually exists. And they're also asserting that everything that should be in the fixed asset listing is there. So that is completeness. So when we're looking at existence for an account balances, is what we're doing is we're testing from the perspective, we're taking items from the ledger that defines the fixed assets and looking for its existence. I've done many fixed asset accounts and basically, or fixed asset audits, and basically what we're doing is we're taking a random sample from the fixed asset list and finding the asset and making sure that it actually exists. Okay? Now, conversely is we're looking at completeness. Well, what is completeness? So what we would do is we would take randomly, we would pick fixed assets that we see in the organization and trace those back to the ledger. And what we're doing there is we're confirming that the asset listing that management has is actually complete. Now, when we talk about assets, we're also talking about rights and obligation. So as an example, inventory, it may exist, but the question becomes is, do these items that are in inventory that are there, does the organization have rights to these? Well, as an example, inventory may be there on consignment. So you go to any grocery store, most of the inventory that you see on the shelf doesn't belong to the grocery store. It actually belongs to the vendors, and the transaction is not actually complete until the item actually gets sold. In the hospital market, if you go into the emergency room, you're in to see a lot of various stents and other items within surgery. Those items are there, they exist, but the hospital doesn't have ownership of those. Those actually belong to the vendor, and the vendor retains ownership until they're actually used in surgery. So there's various elements related to these accounts that we need to keep in mind. We think about valuation and allocation. Well, allocation is making sure that we are looking at each of these items appropriately in terms of the appropriate account. But in terms of valuation, kind of think about the valuation of accounts receivable. How does management value accounts receivable? Well, management values accounts receivable from the perspective of the account balance for accounts receivable less the allowance for doubtful account. So the net accounts receivable essentially represents the value of those accounts receivable in terms of its redeemable value. Let's look at this concept of existence and completeness, but look at it from a transactional perspective. transactional perspectives, we're looking not at existence, but actually occurrence. So let's consider this from the perspective of revenue. When we are testing revenue, we're testing it certainly from completeness. So we want to make sure that every transaction that took place actually is recorded. But we also want to make sure that every transaction that was recorded actually occurred. One of the things that we might be doing, depending upon the organization, start looking at shipping invoices. Well, if we ship it, chances are we sold it. If the customer paid, chances are that's proof that the transaction actually occurred. So what we're looking for in terms of our audit is we're looking for proof that items on the revenue, as an example, expenses, same thing, but items that are there actually occurred, transactions actually occurred, and that every transaction that did occur actually is reported appropriately. We're certainly looking at accuracy. Cutoff is basically looking at it from the perspective of, is the transaction reported in the correct year? When you do your CPA exam, you're clearly going to see issues related to the fact that the items that were sold on December 31st but not shipped until January 3rd, where is that transaction? Is it this year, or is it next year, or this year, or is it last year? Those are the kinds of things you're going to be looking at. Disclosures, we're looking at occurrence, rights, completeness, accuracy, classification, and understandability. So the basis of our audit is the management assertions, and this table here really identifies what these management assertions are. So we talk about existence and occurrence, and again, these are our account balances, rights and obligations, completeness. I think we've pretty much covered all of these issues here. Let's go back to this concept of audit risk. And we're all moving together in terms of what it is that we're attempting to do related to the audit. So we're testing based upon management assertions, but we're only testing enough so that we can issue an opinion with a limited audit risk. We want to keep our audit risk as low as possible. Audit risk is the product, the combination of three items. This is actually one of the most important slides that are here. In many textbooks they define these in terms of numeric values. I'm not so much interested in that. What I'm interested in thinking about is in terms of the relationship of these elements to the overall process. So again, we want to keep audit risk low. If inherent risk, as an example, is high, we want to compensate that with control risk or detection risk. But again, let's just kind of think through what each of these items are. So when we talk about inherent risk and control risk, we're talking about the risk of material misstatement. So in an inherent risk or control risk phase, as we are doing an assessment of the organization, we are doing our test of controls, and between these two items we are determining the risk. And again, it's not the actual material misstatement, but it's the risk of material misstatement. Based upon this is the auditor adjusts the detection risk either up or down to accommodate the risk of material misstatement. We'll talk about this from a couple of different perspectives, but let's just sort of understand this. Inherent risk, what is inherently risky about the account balance, the item, or the transactions that we're actually looking at? So as an example, if we're looking at cash, cash is inherently risky. If we're looking at, say we're doing an audit of a diamond retailer, inventory is inherently risky. These are small items with a very large dollar value that are easily transferable to other people. So people want to steal them. So inherently, cash, diamonds, these kinds of things are inherently, the nature of these items are risky. Okay, so the nature of the item relates to inherent risk. Control risk essentially is an expression of the level of control that management has in place to prevent or detect on a timely basis the things that could go wrong. So we're talking about the internal control structure within the organization. So if the organization has a very strong control framework, then the control risk is very low. So we're actually compensating for the inherent risk. So as an example, cash inherently very risky. Well, if management has appropriate internal controls, and we'll talk about these internal controls when we talk about specific business processes over the next couple of lessons, but the idea is that if the controls are able to compensate for the inherent risk, then the risk of material misstatement is going to be low. But if we go in there, we see we have risky items, we say the organization is at risk for various reasons, then what we want to do is we look at management. What is management doing to control these inherent risks? And if management doesn't have a strong internal control process in place, then we would say that the risk of material misstatement is high. We talked about detection risk. Detection risk essentially is what is within the control of the auditor. The auditor manages detection risk in relationship to the risk of material misstatement. So if the risk of material misstatement is high, the auditor will reduce the detection risk, and the auditor will reduce the detection risk by compensating for the risk of material misstatement in three different categories: the nature of the testing, the amount of the testing, and the timing of the testing. We'll talk about these nature, timing, and amount in a few minutes, but just kind of keep in mind that as an example, if the risk of material misstatement is high, the auditor is going to do additional testing. And when we talk about testing where we are measuring misstatement, we're talking about our substantive testing. It's very important to understand that we need to make this distinction between control testing and our substantive testing. Now, control testing also includes our substantive testing as it relates to the Sarbanes-Oxley 404 testing for the test of internal controls over financial reporting, and we'll walk through this. But as it relates to the financial statement, it's very important to understand that the auditor, when he or she is doing testing to measure monetary misstatement, the testing is our substantive testing. And this is the piece that we're going to modify based upon the risk of material misstatement. So we talk about inherent risk, the nature of the client, the environment, and this is the nature of the financial statement element, again, cash or whatever. This is really one of the reasons that we do a risk assessment of the organization. We understand the entity and its environment, and we're doing this because this is how we actually determine the inherent risk. And then we granularly go down to the financial statement element and identify specific risks related to this. Assertions with high inherent risk. These may be transactions that are difficult to audit, maybe complex calculations, difficult accounting issues. So I'm actually doing a research project with a gentleman that's in the construction industry. and he's looking at controls specifically related to the reported revenue in the long-term construction projects. Long-term construction projects, we're using something of a percent of completion, and that is actually one area that actually is very difficult to audit, very difficult to calculate, very difficult to determine. There may be inherent risk related to the nature of the element. Cash, as an example, may in fact be one of these items. When we're looking at transactions, we want to consider the fact that there are many routine transactions. Generally speaking, there's going to be a low inherent risk related to these. We do want to make sure that the control risk is managed in terms of most of these transactions are going to be going through an IT system. Well, we clearly want to make sure that we understand the internal control structure related to IT. Non-routine transactions are manual transactions, things with high inventory, physical inventory, value, those kinds of things are going to be with a high inherent risk. And anytime there is an estimation, there's going to be a high inherent risk. Estimation are some of the things that we do, as an example, related to transactions or related to our estimates for, as an example, the allowance for doubtful account. Well, the allowance for doubtful account is one of these items that in fact may be inherently risky depending upon the organization and depending upon the ethical values and other sort of non-monetary elements related to the organization. Now, we want to consider appropriateness. Appropriateness, we have a couple of issues related to this. Sufficiency is, are we actually looking at enough evidence? And then what we want to consider is the evidence relevant to the management assertion, and then is the evidence reliable? So it's usually more reliable when it's coming from independent sources outside the organization. It's gathered through a system of effective internal controls, which is why we are very interested in making sure that we have a strong understanding of the internal controls within the organization as we are completing the audit. That's actually one of the first things that we want to do. Most audits start with a control assessment of the IT system. And the reason we're doing this, again, go back to the routine transactions. We're not going to see a lot of risk related to the routine transactions unless we find out that the internal control structure within the IT system are very weak. Before we actually do any testing, we need to understand what these controls are. Evidence obtained directly by the auditor is critical. So if we actually see the item, so as an example, when we do testing related to inventory, we're actually in the inventory area. We can actually view what's taking place. We're actually picking up the items, shaking the boxes, making sure that there's something in these boxes and doing test counts. Well, that's evidence that we're gathering. That's frankly the highest level of evidence that there should be. There's ways to get around that if someone really wants to perpetrate fraud, but in general, that would be a high level of reliable evidence. If we look at documentary evidence rather than oral, if someone tells you, oh yeah, we do that, that's one thing. But if we look at documents to show that they actually did that, that is actually more important. Looking at original documents rather than copies is important. Now that actually becomes somewhat problematic because we live in an environment where we don't actually get copies or we don't get original. So as an example, our bank doesn't mail us our account balances. They email. So you got the PDF. Well, you know, the reality is that someone with a Photoshop could create some sort of document that looks very official. So we need to be aware of where these documents are coming from. And again, it's one of the reasons that we consider that some of these items that we want to get from an outside source. So we're looking at risk to understand the client. And again, we're trying to understand the client from the perspective of what are inherently risky areas that we want to tap into. We then do our test of controls. Our test of controls is where we are measuring our control risk. So our risk assessment procedures, and we'll talk about these, that include things like analytical procedures, an assessment of the industry, of the client, of other items. Then we go into our test of controls. These two items define the risk of material misstatement. When we're doing our substantive procedures, we are then measuring the monetary misstatement. So we want to make sure that we understand this. Now keep in mind that these further audit procedures can in fact include test of controls, again, if we're considering this from the perspective of the 404 testing for Sarbanes-Oxley. Some typical audit procedures: inspection of records and documents, inquiries of people within the organization, outside the organization, external confirmation. So we'll actually talk about things such as confirming accounts receivable balances, getting confirmations from lawyers, getting confirmation from banks. Inspection of tangible assets, so we actually see the asset there, we touch it. That's a good documentation procedure to validate that in fact the item actually exists. Observation, so you notice that we do observation and inquiry. One of the primary tools that we have in terms of assessing internal controls is observation and inquiry. Observation and inquiry is asking a lot of questions and observing the process. So when we're observing the process, is we then become a part of the process. Generally speaking, when I'm doing observations, I'll ask a lot of questions and not ask these from the perspective of I'm trying to figure out what's wrong, but the idea is that I'm only at this point trying to understand what's taking place. So I generally will work with the client and say, okay, well, pretend like I'm a new employee and you're training me on how to do your job. And that really sort of focuses the attention on what they're doing as opposed to what they should be doing. And then once we assess it, then we can determine whether they're doing it correctly or incorrectly. But at this point, we're just observing. We're trying to understand the process. We want to do recalculations for mathematical accuracy, reperformance of many procedures, and then we talk about these analytical procedures, which we'll get into. We talk about substantive testing. Substantive testing, again, relates to where we are measuring monetary misstatement. Substantive testing can be analytical procedures, and we'll drill down on analytical procedures. Analytical procedures are simply mathematical models. Many of them are the various calculations and items that you're kind of used to. As an example, days sales outstanding, credit to debt to equity ratios, profit margins, and so forth. So we can do analytical procedures. We actually have to do analytical procedures as part of our initial assessment. We have to do analytical procedures at the end of the audit. But in terms of the audit specifically related to substantive procedures, there's various components of the audit that are very easily and efficiently done with analytical procedures. As an example, considering the allowance for doubtful account balance, is testing this through analytical procedures, frankly, is probably the best way that we want to do this. Then we're looking at test of details, account balances, transactions, and disclosures. And again, we're looking at this from the perspective of measuring monetary misstatement. One may change the scope of the audit by changing the nature, timing, and extent of these procedures. So I had mentioned these three words before. We'll actually get a little bit in more detail on these. So the nature and timing of the test is we hold the extent of the procedures constant. One may increase the scope of procedures by either changing the nature of the testing or the timing. So if we wait to year end to obtain evidence, that generally speaking means that we are increasing the scope of the audit and decreasing our detection risk. So the higher the risk, the more we want to do the testing at year end. If the controls are great, we're going to be doing testing throughout the year. A lot easier that way. The problem with testing throughout the year is we're only testing to, say we do the testing in September, and the question then becomes, well, what happens after we complete the testing until the year end? So waiting to year end is an example of what we would want to do if in fact the risk of material misstatement is high. The nature of the testing is we're looking for more reliable evidence. I'm going to defer talking about this. We'll actually talk about nature of different types of testing when we give specific examples, such as confirmation of accounts receivable, but I would just hold off on the describing that. The extent of the procedures essentially is the more you do. So the more you do, the greater you're able to understand what's taking place. So we always audit on a sample basis, but if we're auditing on a sample basis, we need to understand that the sample size is dependent upon the risk. The higher the risk, the greater the sample size, and again, the greater the sample size, the lower the detection risk. So let's talk just very briefly related to analytical procedures. Analytical procedures, as we have talked about, relate to mathematical models that we use to better understand the organization. We can also use analytical procedures in substantive testing where we are measuring monetary misstatement. And we'll give some examples of these as we go through the various components of the audit. But in this case, what we're looking at is analytical procedures must be done as part of the planning testing. It is required. And essentially, we're doing this to understand changes in the organization, both from year to year, as well as outliers as compared to industry standards. So the idea in these analytical procedures is we're trying to find out where the risk areas are within the financial statement. What's also required is analytical procedures at the final phase of the audit, and prior to actually completing the audit is we take a step back and do some additional testing related to analytical procedures and basically make sure that we haven't missed anything. Because keep in mind that during the course of the audit, we may in fact have requested changes to the financial statement. So if we're actually doing that, is what we're looking at is we're trying to determine whether or not anything is going to be identified as a risk area that we haven't identified. So we develop expectations for accounts or ratio balances. We want to determine the differences that can be accepted without investigation. We're basically doing these analytical procedures to become efficient in terms of the areas within the financial statement that we want to focus on from a higher or deeper level. Chapter 6 is really talking about obtaining the client and the planning procedures in terms of a new engagement. So when I have a proposal, make arrangements. Now, you notice this, that what we're interested in is communicating with the predecessor auditor. So what we're talking about here is that if a potential client calls us up and says, we would like you to possibly do our audit, is before we accept the audit, is we would request to talk to the predecessor auditor. Now, we can't call the predecessor auditor without permission, but assuming we get that permission, is what we would be doing is we would talk to the predecessor auditor and understand a couple of things: integrity of management, disagreements with the accounting principles or any disagreements, any communications that we've made to the governing body, as well as maybe outside entities, communications with management related to internal controls. We want to identify potentially why the predecessor auditor thinks that the auditor is changing. And the overall integrity of management is very important because, again, there is a risk associated with the audit. The risk is that if the audit goes bad because we have a client that is unethical, is guess what? We're going to suffer. We talked about legal liability in our last lecture. One of the things related to legal liability is, in fact, we have a tremendous amount of liability related to this. So not only liability from a financial perspective, but there are risks, engagement risks associated with this. So we want to make sure that we are aligning ourselves with ethical clients. Now, the question becomes is, what if the client says, no, you cannot communicate with the predecessor auditor? Well, the standards basically say that that should be a sign that maybe there's a problem, but you're not prohibited from taking the client even if management does not allow you to take or to talk to the predecessor audit. So let's talk about some of the audit steps. So after we obtain the client, we need to plan the audit. We need to understand the client and its environment, including internal controls, assess the risk of material misstatement, perform further audit procedures, and complete the audit. Where we are assessing the risk of material misstatement, 4 is our further audit procedures, including test of controls, for our testing for our Sarbanes-Oxley internal controls over financial reporting, and the substantive testing where we are measuring monetary misstatement. Then we issue the audit. But there's some specific planning steps that become very important. And this actually is a little busy here. Strongly suggest that you pick this out of the book. Take a little bit of time in terms of looking at this. But in terms of planning, what we want to understand is a strategy related to the audit, a plan related to the audit, as well as a program. Well, the first thing we want to understand is we want to make sure that the people that are doing the audit are independent. So there may be people within our organization that are not independent. That's fine. They just can't be a part of the audit. We want to understand, is there a need for specialists? It's okay. We can use specialists. But the first thing that we want to do is we want to establish an understanding with the client. This is through what we call an engagement letter. So the engagement letter determines the relationship with the client. It identifies the responsibilities of the auditor, identifies the responsibility of management. There may be timing issues in there, and clearly identifies fees associated with this. We also, again, need to make sure that everyone on the engagement team is independent. We want to make sure that there's no issues related to management integrity, and we want to make sure that the client understands the engagement. And surprisingly or not, a lot of organizations, even though they are paying for the audit, may or may not really understand what the audit is all about or what the output of the audit is. Again, the output of the audit is to audit the fair presentation of the financial statements. It's not to audit management. Management may be doing a terrible job, but that's out of our scope. As long as we're looking at the financial statements and see that what's in the financial statements represents the actual state of the organization, then we're going to be issuing an unqualified opinion. We need to determine, to assert within the management letter that management is responsible for the financial statements. They're responsible for the internal control structure, compliance. They want to make sure the records are available to the auditor, that they will be providing written representation. There's a management representation letter that's signed at the end of the audit that we'll actually talk about later. The auditor's responsibility is conducted in accordance with the generally accepted auditing standards. We are understanding the internal control structure, and we are doing communication items. Some timing issues. We may put in the contract that internal audit is actually going to be assisting us. We're going to identify whether or not we use specialists. Again, internal auditors, that's going to be in the contract. We probably would not put in the engagement letter that we're going to be using specialists. We clearly need to identify information from the predecessor auditor. Just kind of keep in mind that the predecessor auditor audited the ending balance from the prior year. Okay, some of those items from last year are going to flow into numbers that are going to be part of the calculation for this year. So as an example, ending inventory, critical to understanding the inventory so that we can understand what our cost of goods sold are for the following year. So we need to get information from the predecessor auditor. Now, if we can't get this, then unfortunately we may actually have a qualified opinion based upon some areas that we don't have. We clearly want to identify fees and other billings. The scope of the audit, it may in fact include the internal controls. We would identify limitations and conditions under which access to the auditor's working papers may be granted. So we look at the audit planning. So we want to develop an overall strategy for the audit. So the strategy is at the top, and then underneath that is the plan. Are we going to use the client staff? Are we going to use other CPAs? Are we going to arrange for specialists? If this is the first year, how are we going to communicate with the predecessor auditors? How are we going to establish opening balances within the financial statement? Now we're talking about the risk assessment process. So kind of go back to our prior discussion specifically related to the audit risk model. So the audit risk model, that first piece is the inherent risk. So we're now going through that process of the inherent risk. We'll make inquiries of management. Inquiry and observation, absolutely critical in terms of understanding the risk, as well as understanding the inherent risk and the control risk. Our analytical procedures, we've talked about that. We're doing analytical procedures really to understand how the financial statements have changed over time, as well as how the financial statements compare with industry standards. This may not tell us that anything is wrong, but based upon the results is we will be able to zero in on specific areas that are critical to the financial statements. Other procedures, talking to legal counsel, valuation experts, reviewing information from external sources, analysts from banks, rating agencies, organizations, and journals. When you're thinking about the risk assessment process, you notice that we're not doing the kind of testing to actually measure things. We're looking at it from a process perspective. And in fact, when you take your CPA exam, you always want to look at the question and understand where you are in the process. So if it says in the beginning phase of the audit, well, in the beginning phase of the audit, this is where we're doing our risk assessment. We're not doing measurements. We're really understanding the process. And that's the goal, is we are looking at this from the risk of material misstatement. We are not measuring monetary misstatement. So again, back to the term that we are understanding the client, the entity, and its environment. So we're looking at competitive position, organizational structure, accounting policies and procedures, ownership, capital structure, products and service lines, critical business processes. We want to understand where this company is in relationship to the overall environment. Is it in a growth industry? Is there significant competition that is putting pressure on the organization in terms of costs, in terms of other areas? Is there a high turnover? Did they just issue bonds, or is there a bond payment that's due in a year that is going to impede the organization? all these kinds of things is important. Everything that we ask, and again, we're only going to find these things out if we ask the questions, but all this stuff becomes critical to our understanding. We clearly want to understand the industry and the regulatory issues. One of the things that you will probably see as you are working through your audit, that you become an expert in a specific field. So you may end up in banking, you may end up in healthcare, you may end up somewhere. And the reason this is important, you as an auditor, clearly you need to understand the auditing process, but it's also absolutely critical that you understand the industry. So if you understand the industry, you're going to be able to understand the regulatory factors and other issues that are impacting the organization. Okay, so as an example, say you're working in healthcare. Well, how is the Affordable Care Act going to impact the hospital from a competitive perspective, from a revenue perspective? There's all kinds of things that are going to impact the organization based upon regulation. Regulation can be quite complex, which again is why you will probably end up focusing in a single industry. So we want to understand the business risks, financial strategies, threats to achieving objectives. We want to make sure that they are measuring things appropriately. First thing that we want to understand is the budget. Do they have a budget? How do they actually manage this budget? And in fact, remember when KPMG was doing an audit that I was very intimately involved with, is they went through every budget report for every month, and they were expecting a narrative for any time there were budget variances that were in excess. I forget what the percentage was, but they were looking for management's interaction in relationship to the budget, as well as key performance indicators, variance analysis, segment reporting purposes. All this stuff is not gap reporting, but internal management reporting that is absolutely critical to prove or to show that management is actually understanding what's taking place within the organization. Internal controls, absolutely critical. We have and will continue to talk about the COSO model of internal controls. This is the framework that we use in terms of assessing internal controls within the organization. So we need to understand how controls work. What are the controls? Who performs them? How do they affect transactions? And when they're recorded, what accounting records and supporting documentation exist? Now again, back to the model, okay, audit risk. Audit risk equals the product of inherent risk times control risk. Well, control risk, we measure this or we assess this by assessing internal controls. If the internal controls are good, then our credit or control risk is low. You notice here also that we talk about transactions. So when we're looking at assertions, when we look at transactions, we're primarily looking at controls, because transactions, what we're measuring is the process. So the revenue process. The revenue process relates to transactions, which relate to internal controls, which relates to our overall assessment of the risk of material misstatement. Inquiries, accounting guidelines, industry risk alerts, trade journals. Again, back to the fact that you need to be an expert in the field in which you're auditing, is you're going to deep dive and understand everything about the industry as you're doing these audits. And it's very difficult to sort of move from industry to industry. As an example, very strong in healthcare. I think I would be a disaster if I went to a retail store and did an audit there, because I don't know. I don't understand the issues in the industry as it relates to this. So we're looking at prior service or tax returns. All the information really provides value to us. Observations are going to come from a tour of the plant. And again, we're talking about analytical procedures. Want to determine materiality. Actually have a short video, and I don't think I've actually presented this yet in terms of materiality. But materiality essentially is on a professional judgment. What is the level of error that can be there that would not change the decision of the user of the financial statement? So we're looking, again, it's a professional judgment in terms of how much this should be. But the larger the organization, the greater the material error. We clearly would not be including this, will not be telling management this, because if we say, you know, we have an error rate, we allow an error rate of $1 million. Well, guess what? As long as everything is within $1 million, they're going to be fine. So we don't tell them what our materiality is. But what we're looking for is a threshold by which, as we are assessing the accounts, if they're within this material level, then we are going to accept that the presentations are presented fairly. And again, in this audit planning stage is what we're looking for, is we're looking for this process in terms of understanding the client, making sure that we have an ethical client that we're working with, and doing very specific things as it relates to the process. This relates to what we talked about in the Chapter 5, where we have the audit risk model. The audit risk model is where we consider the inherent risk, the nature of the accounts, the control risk, the internal controls that management has put in place. The inherent risk and the control risk define the risk of material misstatement. Once we've defined the risk of material misstatement, is we determine the nature, timing, and extent of our further audit procedures. And these further audit procedures include additional tests of controls for our integrated audit of internal controls over financial reporting, and our substantive procedures where we are measuring monetary mistakes. This was a very important lesson. Hopefully you have gotten a good idea in terms of what this process is. As we continue forward and we start talking about very specific accounts, is what you're going to understand is how these things basically work together. So in any event, I thank you very much for your time. We will continue this, I believe, in 2 weeks. So I thank everyone for their time and attention, and we'll talk again. Everyone have a great evening. Okay, thank you very much.